2023. No, 2022, April 2022. Question number 3B, April 2022. Question number 3B. So we have here components of the sales margin variances. Now, generally, these are divided into two. They're divided into two. Can just draw like that. So we have the first component is called the sales margin price. Sales margin price variance. Sales margin price variance. Sales margin price variance. And then we have here the sales margin volume variance. Sales margin, volume variance, volume variance. My pen is not the very best, but we shall overcome. So this one has got two babies. We call them babies. Two babies. So these babies are the sales margin mix variance, sales margin mix variance, sales margin mix variance, and then we have lastly the sales margin quantity variance. Sales margin quantity variance. The sales margin quantity variance. The sales margin quantity variance. Sales margin quantity variance. That camera not the very best, but we shall overcome. Let me try to dim it a bit. So bright. So bright. I hope that is a bit better. I hope making it that way makes it a bit better, but some students complain that it is too dark. What do you think of that board? Is it a bit better? Is it much better? You should talk of much better. Perfect, great. Thank you so much. So then let me know once you guys are able to finish drawing this. When you finish drawing this, kindly go ahead and tell me, hey, now I'm through. Done. Thank you so much. Done. Thank you so much. And have you told your colleagues in class, in your WhatsApp group, that the class has begun? Because it's a class that has got about 120 students, teaching only 50 something. Not very good. Not very good. Oh, it's dim. You want it to be brighter. You want it to be brighter. You want it to be very bright. What do you mean? You want it to be very bright. They want this to be very bright. You will not be able to see the board very well. You won't be able to see the board very well. Done. All right. So then I'll be able to work on the brightness. But before that, adjust the ISO. Wow, this guy must be... This guy must be a genius in this game. Do you want to tell me that you see it this way being better that way? Is this okay now? Okay, great. Thank you so much. Then let's continue here. Let's continue here. So then we have a question that we have here that should be able to help us understand this very well. These sales margin variances. There are times the examiner gets my students off guard by giving them this kind of a question. So we are doing this April 2022, question number 3B. We are told that Dominion Beverages Limited makes and sells two beverages products branded Bingo and Boost. Bingo and Boost. So you can see the budgeted sales and the profits for the year 2021 were as follows. So you're able to see product Bingo and Boost. We have actual sales were as follows, Bingo. Then we have, in this case, a Boost. The company management is able to control the relative sales of each product through the allocation of sales effort advertising, and the sales promotion expenses. So required, calculate and interpret the following variances. The very first one is the sales margin price variance. So we start with the first one, which is the sales margin price variance. So we have here sales margin, price variance, sales margin, price variance. Is there somebody who can try guessing here? This is quite confusing. Most students in this case here talk about the standard price minus the actual price multiplied. No. This is sales margin price variance. To get this sales margin price variance, ladies and gentlemen, this is normally what we do. To get the sales margin price variance, this is normally what we do. To get this one, this is normally what we do. So we normally talk about differences between two margins. So we have here the standard margin, or in this case here, standard profit. The standard profit minus the actual profit. Actual profit, of course, it has to be per unit. Actual profit per unit multiplied outside here by the actual quantity that was sold. Actual quantity that was sold. Multiplied by the actual quantity sold. So anytime they talk about sales margin price, so it is this margin that takes preference, that takes precedence. So you talk about differences between two margins here. We have the standard margin or profit per unit here, per unit, minus the actual margin per unit. And then we multiply this by the actual quantity that was sold. So we start with the first product. The first product here is bingo. We start with bingo. So bingo. So is there somebody who is able to see the standard margin for bingo? Is there anybody who is able to see the standard margin for bingo? Standard margin for bingo. Standard margin for bingo. Anybody who is able to see the standard margin for bingo? No. You see 2,000 is for the whole of it. 2,000 profit is total. Thank you, Ruth, but 2,000 is total. But I like the fact that you've been able to go to the budget there to pick. So it will be 2,000 divided by 400. It will be 2,000 divided by 400 units. So to get profit here per unit, you will take here 2,000, which is the total profit, divided by the number of units here, which are 400, like that. Minus the actual profit per unit. Please go to the actual information. Are you able to see the actual information? What do we have there for bingo? What do we have there for bingo? Actual sales were as follows. Is there somebody who is able to see the actual profit per unit? Somebody talk to me. Talk to me, somebody. It's 5.3, isn't it? It's 5.3. So this is 5.3. 5.3. And then, of course, we have the actual quantity sold of bingo, which was 400. No, not 400. Not 400. The actual units of bingo sold were, in this case here, were what here? Were 280. These were 280. 280. Thank you so much. So are you able to give me this variance? So this is quite confusing. I agree, it's quite confusing, but very easy. Once you have started mastering them, it becomes very, very easy. It becomes very, very easy. So then are you able to give me this? So this gives me 84. Is it 84,000 or just 84? 84. It is just 84 like that. 84, and these students are getting a negative answer, but they have remembered very fast that sales variances are what here? They are exceptional. They are to be interpreted in the opposite way. They're exceptional, they must be interpreted in the opposite way. So when you get a negative, you take that to be favorable. So from there, go to boost. So the first one is bingo. The second one is called boost. Great product here. So boost. So for boost, are we able to see the standard margin per unit? I can see the total profit there for boost is 900. So the 900, I will have to unitize this, make this to be per unit. So 900 divided by 300 to get profit per unit as per the standard card, minus the actual profit per unit You can see actual information boost was 630 units with a profit of 280, a profit of 2.8, I mean, times, in this case here, the actual number of units of boost which were sold, which was 630, So are you able to give me this answer, my good students? Which was 630. Are you able to give me this answer? So 126 what here? 126 30 bars. So come and combine here to give me the total variance. Total sales margin, price variance, sales margin, price variance. So as you add, remember this is 84 positive minus 126. Which gives me 42 adverse. So here I would want to draw your attention to this fact, sales margin variance. Actually, whenever I see this sales margin price, what I normally do myself is to cancel this word price. It can really mislead you and you think it's a price variance. So it is sales margin variance. And to get this sales margin variance, we are looking at differences between two margins. What we thought would have been our profit per unit, what we are calling here the standard margin minus the actual margin multiplied outside here by the actual quantity that were sold here, actual quantity were sold. So please keep that question, keep that answer like that. And then now we go to the second one, what they are calling sales margin, but now volume variance. Sales margin, volume variance. Sales margin, volume variance. Is there anybody who is able to write for us that formula? Sales margin, volume variance. This will never ever confuse me. Never. Because it's so easy, it is self-explanatory. Sales margin, volume variance. So the sales margin, volume variance, how do we get this difference between two volumes? So we have here budgeted volume minus actual volume. And because they have used the word margin outside here, then I'll come and put here standard margin to monetize. Standard margin per unit. So this is budgeted volume sold or to be sold. Budgeted volume sold because the sales variance. And this is actual volume sold like that. Actual volume sold. So we start with the first component, first material, first product there called bingo. So bingo, are you able to see the budgeted volume? Are you able to see that? Julian has already been able to see this budgeted volume. And you know, management accounting is a very, very good subject. Actually, if I were a young man today, I would think of being a management accountant, of course, chief, not junior. It's not very good to be junior. Chief management accountant of one of these big companies like Unilever, right? We have in this case even most of these big companies, management accountants are really paid heavily. Why? Because they're the ones that give management information that they are going to use to make decisions. Serious organizations have management accounting departments. Is there anybody here who is working for a company that has got a management accounting department? Anybody working here for a company that has got a management accounting department? You know, most of us are used to financial reporting, reconciliations, etc., tax accountants. Do we have anybody who is working for a company that has got a management accounting department? Don't tell me that all of us are working for small firms. At least Lillian. Yeah, costing is the same as a management accounting, yes. Like Rodiams is saying he's one, you must be in a very, very good role. It's a role if you develop it quite nicely, become so good in terms of planning and making budgets, tell them that you know how to flex budgets, tell them that you know how to do the costing bit of it in a way that, you know, most businesses sell goods at a loss because basically they're not doing costing of their products nicely. You'll go to a hotel will just look at the next door neighbor, they're selling chapati for 50 and then they start selling for 50 as well, or even less. Not knowing that there are so much expenses in this case that have to be absorbed into that chapati for you to be able to add a profit margin, to be able to know an appropriate price. So management accounting is a subject I would want you to really love. Very good paper, very good paper. Absorption of cost, yes. Yes. So then we have here bingo, budgeted volume. Are you able to see bingo budgeted volume ni ngapi? Bingo budgeted volume ni ngapi? William alone. From the budget up there, it's 400. So this is 400. We come and deduct, in this case here, the actual volume that was sold for bingo, which is 280 from the actual information, 280. And then we'll come and mention here, the standard margin per unit, most of you, I don't know whether you'll be able to remember this. It's 5 years. It's 5 years. So please go ahead and give me this sales margin volume variance for bingo. For bingo. Don't forget that sales variances are what here? Don't forget that sales variances are exceptional. Interpret them in the opposite way. So Vero has said 600 adverse. Vero can't cheat us. It has to be 600 adverse. 600 adverse. Is there a question that I've seen there? 600 adverse. 600 adverse. 600 adverse. 600 adverse. Where is 5? Sherry is asking where is 5? We got it earlier on. It was the profit per unit. If you remember bingo, if you can see the budgeted table, if you can see the budgeted table, thank you for asking a good question there. If you see the budgeted table, it is 2,000 divided by 400. 2,000 divided by 400. For Paul, remember Paul, we are not talking about actual margin. Paul, in this, the whole of these variances, whenever we have money outside, when money is outside, it must be standard. It must be standard. So the standard, Paul, is 5. The 5.3 there is actual. Paul, are we together? Paul, are we together? Paul, are we together? Okay, great. Then we go to boost. So boost, what do we have there for boost? We have budgeted volume sold. For boost, budgeted volume sold there is 300 to be sold, of course. 300 minus the actual volume which was sold, 680, 630, I mean, 630 into, are you able to see the standard margin per unit? Standard margin per unit, 3. So please give me this answer. Please give me this answer. Please give me this answer. Are they able to get this answer? So 990 favorable. So this is 990 favorable. 990 favorable. So please give me the total sales margin volume variance. Margin volume variance. The total sales. So you add. So this is minus 600 plus 990, which gives me what here, somebody? 390 favorable. 390 favorable. 390 favorable. If you look at part 5, they want me to give them the sales margin total variance. So part 5, I can do this right away. The sales margin, total variance. If you remember our diagram, we had the sales margin price, the two of them, these were the two babies, sales margin price variance. And then we had, in this case here, the sales margin volume variance. Those are the two babies. When you put two babies together, you get the parent here, sales margin volume variance. So then, can you kindly go ahead and give me this? Kindly go ahead and give me, remind me. I know this is 390 favorable. The margin volume is 390 favorable. This one you're getting 80 something. This one you are getting 80 something. The sales margin price, you are getting 80 something. If I remember very well, was it 80 something? The sales margin price, the one that we did up there. I'm even now doubting. 42, eh? The one that we did up there. Combined, remember combined, Juliana. Was it 42? Was it 42 adverse? 42 adverse? 42 adverse? 42 adverse? Okay, for 2 adverse. So for 2 adverse plus 390 favorable, this will end up giving us what figure, somebody? For 2 adverse plus 390 favorable, will end up now giving us what figure? 348 favorable. So this is 348 favorable. So those 3 done. So long as you name your number, you put in your numbers very well. The total variance, the sales margin total variance is the sum of the two. It is the sum of sales margin price plus sales margin what year? Volume plus sales margin volume variance. All right. So this will become clearer as we progress. So then let's get to this serious part of this. we get to this serious part, where they want us to give them the sales margin mix variance. Why do interpretation changes? I don't understand that question, Ali, very well. Will it really, are you saying, remember we said here for sales variances, when they are negative, you simply do what here, interpret them in the opposite way. When they are negative, you say they are favorable. If it is the opposite, you know, like, for example, it is like this. If, for example, you have like the normal sales price, for example, you have your standard of 30, actual of say 28, right? And then actual quantity sold, for example, of 100. Can somebody give me this? This is actual. Can somebody give me this variance here? Can somebody give me this variance? 30 minus 28 to 2 times 100. So then this gives us what here, somebody? This gives us what, somebody here? All right. So this gives us 200, isn't it? So you see, this will be 200 what here? This will be 2. Is it adverse or favorable? It's positive. When it's positive like this, we would have taken this positive. Positive means increase in profitability. But remember, sales variances are normally what here? Sales variances are normally exceptional variances. We should be able to interpret them in the opposite way. I'll check this. You see, ordinarily, when it's positive, positive should be what here? Should be favorable. But remember, we have what we call exceptional variances, of which sales is one of them. So this one automatically should be what here? Should that be adverse? Should be adverse. And if you want to get into, like, now the proper interpretation, what is the proper interpretation here? We are saying that this price is what we thought we would have sold our goods at. We planned, we budgeted to sell our goods at a higher price. But now we have actually sold at a lower price. I don't know whether you're seeing that. Selling this at a lower price means bad for our business. Bad for our business. But with the experience, if you start in this case here, then looking at these prices here, trying to understand the interpretations, you will go wrong. You'll be able to spend more time. What in this case here, management accountants have done, they came and they said that all variances, whenever they are positive, then they are what here? They are favorable. Whenever they are positive, they are automatically what here? Favorable, because positive means what here? Increase in profits. Good variances. Whenever they are positive, increase in profits. So profits here, so good, so favorable variances, except these 3 variances. If you remember, those exceptional, except number 1, sales variances. Sales variances must be interpreted in the opposite way. Number 2, we have fixed overhead what here? Fixed overhead volume variance. Fixed overhead volume variance. Number 3, we have fixed over what here? Fixed overhead capacity variance. So they are exceptional, not hard to compute, but whenever we get the values, we will be interpreting them in the opposite way. When they are positive, positive, take them as adverse. Opposite. Negative, take them as what here? Opposite. I hope that makes some sense, Ali. I hope that makes some sense, Ali. I hope that makes some sense. Great. Now come back here. Now, ladies and gentlemen, here we are. The sales mix variance. Sales mix variance. How do we get sales mix variance? How do we get sales mix variance? I've already taught you how to mix these things. Sales mix variance, to get this one, we shall take the sales mix minus, in this case here, the actual mix. And then we multiply outside here with the standard margin, because these are sales margin variances. Standard margin per unit. Standard margin per unit. So take sales mix minus actual mix multiplied by the standard margin per unit. I know where the problem is. The problem is always in getting this. Getting this. Getting this is never easy. I would want to give you exactly 2 minutes. You try getting these sales. I'll come back to that question. Don't worry, I'll come back to that question. So the sales mix variance, just try getting this sales mix alone. When you get the sales mix, I will be very happy. The sales mix. Sales mix of the total actual inputs. Okay. Sales mix of the total actual inputs. Sales mix of the total actual inputs. All right. So bingo is 8. I'm being told bingo is 8. Thank you for trying, but no. No. Remember, this will be the sales mix. This will be sales mix of the total actual inputs. I'll explain something here of the total actual inputs. So we have bingo. We have, in this case here, boost. So we would want, ladies and gentlemen, in this case here, to come here and first of all get what we call the standard proportions. The first thing we'll do is to get the standard proportions from our budgets, from our standards, the quantities. Remember, this is in terms of what here? In terms of sales. In terms of sales. So our budgets there, ladies and gentlemen, what do we have there? Thank you very much, Vero. Thank you very much, Ruth. Our budgets, what do we have there? We can see budgeted sales and profits, and you can see the sales quantities. So the sales quantities, we have here 400, here we have 300. So this will give us 700 in total. So this will be 400 over 700. This will be 300 over what here, somebody? Over 700. Because I want proportions. And then from there, what we shall do is to come and now get, you see, like what I would have called the actual inputs. What I would have called the actual inputs. Actual inputs. So, you know, this is sales. So instead of you talking about actual inputs, you talk about actual sales. Actual sales. Of course, in units here. So are you able to see, like bingo, how many units do we produce? Or rather, do we sell? Bingo. Bingo. How many units do we sell? Bingo. Bingo. How many do we sell? 200 what here? 280, I'm told. 280. 280. And then the other one we sold 600 what here? 630. Please give me the total here. Please give me the total here. Give me the total here. And this is a very, very important. This is a very, very important metric. Very, very important metric. So we have here 910. 910. So this is what is to be revised. This is what is to be revised because you are saying it is sales mix of the total actual inputs. So this is what we would call our total actual inputs, or in this case, we are selling, remember, this is sales, the total actual inputs. Total actual inputs. Total actual sales is 910. So then I'll come and talk about now another column here where I give my examiner, the sales mix, where I will give my examiner the sales mix. Remember this sales mix. How do I get this sales mix? Sales mix of the total actual inputs, of the total actual sales. So I need to come and use the proportions that we have here. I can cut this very comfortably. So like for bingo, I have 4 over 7. For boost, I have here 3 over what here? 3 over 7. So I'm going to say times something because of the off. Who can give me the figure to use here? Who will give me the figure to use here? Who will give me the 910, the 910, 910. Because it is sales mix of, that of in English stands for multiplication. It is sales mix of the total actual inputs, of the total actual sales. So it is 4/7 times 910, 3/7 times 910. If you get these are now the revised standards, the revised standard quantities, the revised standard quantities. So bingo is 520, bingo is 520, bingo is 520, and then we have in this case here, boost is 390, boost is 390, boost is 390. Ladies and gentlemen, I would want to repeat this concept of mixing. Please allow me to repeat. Allow me to repeat. If you give me this kind of a question, this is how I will tackle this. So we have here our products. There are two. We have what we call bingo, and then we have what we call boost. Bingo and boost. Then what I will do, the first thing that I will do is to come and give them the standard proportions. When I'm selling them, from how we had budgeted in this case here, we had budgeted to be selling 400 units of bingo for 300 units of boost. Ukiuza 4 za bingo, unauza 3 za boost. So that's our standard mix proportions. So we have here 400, and then we have 300. So then our total bundle is 700. So change these two. So this will be 400/700. This will be 300/700, which in this case here will cancel like that. So 4/7, 3/7. From there, I can even come and do this by the side. Because now we are talking about units sold. I will come and ask myself, what was the total actual number of units that were sold? Number of units sold. Number of units that were sold. So I'll come and look at the actual number of units sold. They were, in this case here, 280 plus 630. So we have here 280 plus 630, which gives us 910 like that. So this, if it was raw materials, I would have spoken about the actual inputs. But these are sold units. These are sales variance here. So then remember that standard mix, how do I get standard mix? I will take the standard proportions. I will take the standard proportions times the total actual input or sales, depending on what you are handling. Here we are handling sales, so you're going to use the total actual like that. Anytime they want us to give them the standard mix, like if it is standard mix of bingo, I will take the standard proportion, which is 4/7, times the total actual input here, which is 910. So that's bingo. If it's boost, I will come and take 3/7 times the total again. We keep on repeating this total, which is 910. And this is what you are able to get. This is what you are able to get here as our standard mixes for the two products here. So remind me the figures. So for bingo, we have 4/7 times 910. For bingo, 520. So this is 520. You can do this by the side. This 520, this is 390. So this is 390 like that. 390. If you are doing it this way, you must then come and provide a column for the actual mix. Actual mix is the same as actual quantity. So the actual quantity, those numbers there, these numbers here, these numbers, 280 for bingo, 630 for what year? For boost. And once you write like that, then now you can come and give us the sales mix variance. So the sales mix variance, in this case here, we start with bingo. So I'm following that formula. It is a sales mix. Sales mix for bingo, or the standard mix there for bingo is 520. It's 520. You can also make this to be sales for you not to confuse. So 520 minus the actual unit that was sold really. For bingo, it is 280 multiplied by the standard profit outside, the standard profit per unit. You guys are giving me a figure. Do you remember that figure? Standard profit? It was 5 years. It was 5. So times 5 here. So are you able to give me this answer? Are you able to give me this answer? Are you able to give me this answer? Remember, sales variances are exceptional. So 1200 adverse. So this is 1200 adverse, 1200 adverse. And then we have boost. We have boost. So boost in this case here, we have our standard mix there, which is 390 minus our actual. Our actual mix is 630 multiplied by our standard profit per unit, multiplied by our standard profit per unit, which is what? Is there somebody who can remember the standard profit per unit? 3, and then a ninja there is telling me it's 720 favorable. So it's 720 favorable. So this is 720 favorable, like that. So please come and give me the total. Give me the total. So the total, basically this will be minus 1200. This will be plus 720. If you wish, I know now what Ali was asking. If you wish, although this will confuse you, in the totals, if you start taking this as no. So long as you have used that concept to get just the individual, when it comes to the totality, I'll take this as minus 1200 because it's just direction. I would want to know the direction plus 720, which will give me what figure there? 480 adverse. 480 adverse is higher. You double on the line. Adverse is higher. You double on the line. You double on the line like that. You double on the line. You double on the line. Now from there, we do the very last one. We do the very last one. The very last one here is called sales margin quantity variance. So we have here sales margin. We have here, that's number 4 or something. Sales margin quantity. So this one can easily confuse people with the volume. In terms of sales margin quantity variance, quantity is the same as the yield. Is the same as the yield. Is the same as the yield. Yeah, we have to pray. 5 minutes here. So we shall continue from here. 5 minutes here. So we shall come back at exactly 6:51. Thank you. So what I was saying, ladies and gentlemen, here before we went for this break, is that the sales margin quantity variance is what I would say is similar to the material yield variance. All right. However, remember for the sales is quite a straightforward one. You start with the budgeted volume. There is nothing here to be like standard quantity for actual output. No. You take budgeted volume, you subtract standard mix, and then you multiply outside with standard profit per what year per unit. Standard profit per unit. So then abracadabra, what is our budgeted volume? What is our budgeted volume? Budgeted volume for bingo. Somebody is telling me 400. How about the standard mix? The standard mix is 520. Standard mix is 520. Come and multiply this with the standard profit per unit that you guys had obtained as 5. That you guys had obtained as 5. So we have here 400 minus 520 times 5. So give me, remembering that this is supposed to be an exceptional variance. So 600 favorable. So from there we go to boost. Boost, is there somebody who can see the budgeted volume of boost? Budgeted volume of boost. Budgeted volume of boost is 300 minus the standard mix that I can see here, which is 390. Multiply this by the standard profit per unit, which is what here, which is 3, which will end up giving me what figure, ladies and gentlemen? Which will end up giving me 270 what here? 270 favorable, I'm told. 270 favorable. So if you add the two, you will end up getting the total here. So what is the total here? What is the total here? What is the total here? So the total is 870 favorable. So that is it. The total is 870 favorable. 870 favorable. 870 favorable. So ladies and gentlemen, I have a request to you guys. I would want you to take time to revisit the questions that we have done with you in class. Variances questions that we have done with you in class, and ensure that you repeat. I can assure you 100%. You can't miss a question from this area. So I would want you to take your time, you review all the questions you have done in class here, and then I'll only do one question for you to be able to get now deeper understanding of the subject. Otherwise, within this topic, we have in this case here a subtopic called flexible budgets. So give me a title there, flexible budgets. Give me a title there, flexible budgets. A subtopic, still under this topic 7, we have what we call flexible budgets. So flexible budgets. So flexible budgets. So I would want you to mention there that a flexible budget, I mean, is a budget that flexes, is a budget that changes. As the output in this case here changes, a flexible budget changes. So a flexible budget is a financial plan, is a financial plan that adjusts or flexes or changes, I mean, or changes with changes in volume, with changes in volume, or activity levels, or activity levels. Remember, in this regard, we've got two types of budgets. We have what we call, or something is balancing. There is something that is balancing somewhere there. There is something balancing, which is very, very good. Very, very good. So we are saying, ladies and gentlemen, we have what we call static budgets. Like the budgets that we normally make in Kenya here, they are quite static here. So they make a budget like the whole year. They'll be making that use of that budget for trial budget like that. Whenever they have got a few issues in between here, for example, which were not budgeted, then they come up with supplementary. But basically, they have what we call a static budget. But serious organizations like, for example, breweries, Unilever, those guys, the moment they realize that their output is not like how it was projected, we have here the budgeted output was 1 million. And then the actual output in this case is 800. They can't compare unlike items. Those guys will tell you, hey, no, let's flex the budget. Let's, in this case, here, change our budget to mirror the actual output, And for us to be able to understand this, I'm doing my last question for tonight, which in this case here is this question, ladies and gentlemen, that came in the year, or rather sitting, May 2017, question number 3. May 2017, question number 3. May 2017, question number 3C. May 2017, question number 3C. May 2017. So we have here May 2017, question 3C. May 2017, question 3C. Let me know once you're able to get that question. Let me know once you're able to get that question. May 2017, question number 3C. Gotten it. Thanks, Leo. Great. Great. So C, you have been provided with the following operating statement, which represents an attempt by a firm to compare the actual performance with the budget for the quarter, which has just ended. So I can see budget with 640,000 units, and I can see the actual income statement that has got 720,000. That fake management accountant went ahead to get variations between a budget which has got a different quantity from what the actual is. In terms of deviations, we shall always compare budget and actual, and the budget should be having the same number of units produced or to be produced as actual. So in this case here, the budget should have been a budget for producing the actual number of units here, which are 720. So required, using a flexible budgeting approach, redraft the operating statement so as to provide a more realistic indication of the variances. Using a flexible budgeting approach, redraft the operating statement so as to provide a more realistic indication of the variances. So then the very first thing that I will do here pretty fast as an experienced management accountant is to calculate what we call the flexing ratio. So come here and they give us what we call the flexing ratio. Give us here what we call the flexing ratio. How do we get this flexing ratio? To get the flexing ratio, we normally take the actual output. The actual output divided by budgeted output. Actual output divided by budgeted output. So normally take the actual output, we divide this by the budgeted output. So look at the statements given. Is there somebody who is able to see the actual output here? This is very easy. Is there anybody who is able to see the actual output here? This actual data. They've given us actual number of units that were sold. 720,000. So you take 720,000, divide this by the budgeted output. Are you able to see the budgeted output there? 640,000. So then, can you kindly give me this ratio? It will be 1 point something. Give me this ratio. It will be 1 point something. The question is May 2017, question 3C. So perhaps what Mariam wants done is somebody to share that question. Somebody to share that question in the group. Please help Marianne. Marianne. So 1.125. 1.125. 1.125. 1.125. That is the very first thing you do, you as an experienced management accountant. And once you've been able to do that, then go and copy the original budget the way it is. So the original budget the way it is, original budget the way it is, you are copying it the way it is, original budget. So you can see we have sales. Okay, it's very easy. So flexing ratio is an actual output over budgeted output, which is this, and then you copy that, and then you put your thumbs like this. Flexing ratio. So then you shall be able to come and copy the original budget the way it is there. So the way it is there. So I can see we have sales. So I can see we have sales. What else do we have? I can see we have sales. Done. Okay. I can see we have sales. I can see we have sales. Sales of 1024. Sales of 1024. I can see we have cost of sales. Cost of sales. Cost of sales, and all is variable. All variable. Cost of sales, all variable. So there we have materials, labor, overheads. Materials, labor, overheads. Overheads. Then we have fixed labor cost. Fixed labor cost. We have the fixed labor cost. Fixed labor cost. Then if you go down there, we have selling and distribution. So we have fixed selling. So we have fixed selling. We have variable selling. Variable selling. Okay. Then we have administration. So we have fixed admin, fixed admin, fixed admin. And then we have a variable administration. Variable administration. Great. So go ahead and do like that. 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 So cost of sales, materials are variable. I can even simplify like that. Materials are variable, labor is variable, overheads are variable. But now the others have been able to explain. So the sales, what do we have here for sales? Sales is 1024. Material cost, if I'm right there, material cost should be 1. Material cost. No, I don't need those total figures. I don't need them. I don't need them. Thank you, but I don't need them. 168. 168. After 168, I have 240. 240. I have 32. And then the fixed is 100. Fixed labor cost is 100. Fixed selling is 72, 144, 72, 144, 72, 144, and then 184, 48. 184, 48. I think that's it. I think that's it. That's it. That is it. And then, of course, we have our net profit down here. Our net profit down here, which is 50 what here? 56 or 36, like that. Let me know once you guys are able to copy this thing. Let me know once you guys are able to copy this. Somebody has not yet shared the question with this new student. Somebody has not shared the question with this new student. Somebody has not shared the question with the new student. We shall overcome. Done, okay? Thank you, Paul, for done, yes. So then that is it. Our role to be able to get this flexible budget, like now these sales, I'll take 1024. I know sales is something that Dan says. As you sell more units, sales is flexible, it's not rigid. So this 1024 will be multiplied by 1.125. Can somebody give me that figure? So we have here 168 times 1. Anything that is variable, anything that is variable will be multiplied with a flexing ratio. Anything that is variable will be multiplied with the flexing ratio. So please give me these answers. So the first one is 1152. Remember, sales is flexible. Materials are flexible. So I'm taking the original budget figure times the flexing ratio. So here we have 189. 189. We come here to 40 times 1.125, which gives me 200 what here? 270. Thank you so much. And then we have 32 times 1.125. So I'm being given a figure of 36. What do you think of this fixed labor? Can we flex it? No. So this is fixed. It shall remain 100. It's fixed, remains 100. Fixed selling, fixed, shall remain 72. Variable selling, this you have to multiply. 144 times 1.125. That you have to multiply. Great. Thank you so much, which gives us 162. 162. All right. Fixed admin, this fixed. From the name itself, you have 184. We have here variable admin. Variable admin, this I'll have to flex. 48 times 1.125. Don't flex profit. Profit, of course, you'll be subtracting everything. So this is 54, like that. So then can you kindly come and give me the net profit? Don't put like this in negative takusumbua. What you do, just take 1152 minus all these numbers. Give me the net profit down here. Give me the net profit down here. 85. Somebody is giving me a figure of 85. 85. 85. You take 1152 minus this, minus this, minus 85. Thank you so much. So once you get that, then come here by the side. And they give me the actual P&L. You don't flex actual, you simply copy the way it is. The actual profit and loss. So the actual, I can see the actual, the revenue there is 1071. The revenue here is 1071. We have 144, 288. 288. We have 36. We have the actual fixed labor of 94. 94. After 94, ladies and gentlemen, we have 83, 153. 83, 153, 83, 153, 176 and 54, 176 and 54, like that. So you come, now we are comparing like with like. Now remember here, the quantity now sold here, the quantity sold here, the actual quantity now sold is 720. So we have flexed this to match the 720. Quantity sold is 720,000. And even here now, the quantity sold is 720,000. So now we are comparing like with like. Very nice. Very nice. So let me know once you guys are able to write everything up to here. And then the profit, if you're right, the profit should be 43. The profit there should be 43. Now create the last column of variances now. Create the last column of variances. Create the last column of variances. Variances. Once you're done, I can see Frida finished. I can see Juliana finished. So now variances, now we are basically taking, like if it sales, take this minus this. Take this minus the actual. So 1152 minus 1071. Minus 1071. What do we have there? So 81 adverse. 81 adverse. 81 adverse. 81 adverse. Remember, for sales, you shall always interpret it in the opposite way. Sales, you shall always interpret it in the opposite way. Or you reason here. You had budgeted to sell this, you've sold less. How about this material cost? I can see the material cost, the budget was higher. And the actual one is less. So favorable things. Favorable things. So 45 favorable. 45 favorable. Please continue like that. Give me all the answers. 270 minus 288. 18 adverse. Now I'm writing without even reasoning. 18 adverse. 36 minus 36. Is it 0 or 6 or 0? I don't know. This is supposed to be 36. Is this supposed, or I copied wrongly? They copied wrongly. 0. So 0 is neither here nor there. But of course, if you are forced by the examiner to say whether it's adverse or favorable, you will say it is favorable. Why? Because you are well within your budget. But otherwise, it's a neutral number. So 100 minus 94, that gives me 6. So 6 favorable. 6 favorable. 72 minus 83. 11 adverse. 11 adverse. 162 minus 153. 162 minus 153. So this is 9. 9 what here? 9 favorable. 9 favorable. And then we have 184 minus 176. 184 minus 176. 8 favorable, 8 favorable. And then we have lastly 54 minus 54, which gives me 0. So I would want you to do me a favor. Please add all the variances. Like this minus 81 plus 55, minus 18 plus 6 minus 11 plus 9 plus 8. Give me this figure here. Add all of them. They're telling me it is 42 adverse. And you can see it's agreeing with this. Because the profit that we budgeted here is higher. If you take this minus this, if you take this, it will be 42. And of course, reduced profit. So it's agreeing. So thank you very much. And the students, of course, who are watching me on YouTube, you need to subscribe to my channel and ensure that you are liking this particular video, commenting there, ask questions there, and I'll be able to see. And of course, most importantly, share. If possible, share the link with your friends. Make this Mwalimu international. Make Mwalimu international. Great. All sales are exceptional. And Susan, you can also make this arrangement. I mean, you can come and make an argument. I'd planned to sell more, 1152, but I sold less. I'd planned to sell more, but I sold less. So that's adverse. But the very best is what this student is telling you, that we have here. All sales, variances are exceptional. Bye. See you next time. See you next time. Thank you.